Number one, as your viewers know, people have gotten pretty bearish in the last couple of weeks because the government shutdown kind of has deprived the economy of money. And then the Treasury Department isn't dispersing funds, so their liquidity has shrunk. And it's caused stocks to actually wobble. And every time the S&P is down 2 or 3%, or AI stocks are down 5%, I think people get really cautious. I think, first of all, bullish sentiment is not even anchored properly. People become so hesitant. I think everybody thinks there's a top. Here's the thing. When everyone says there's a top, there cannot be a top. The top in the dot-com was because nobody thought stocks could ever fall. They actually thought we were entering like an era of continued prosperity. The second thing to keep in mind is that markets have been strong for the last 6 months. There is incredible demand for equities because people are really off sides. That's what you have to keep in mind. In April of this year, people thought we were facing Armageddon because of tariffs, and you had many economists proclaiming a recession, and that's how institutions traded. They were actually positioned for a massive bear. They can't fix that in 6 months. So we're now getting into year end where institutions, 80% are trailing their benchmark this year. It's the worst performance for institutional fund managers in 30 years, and they have 10 weeks to fix it. They're going to be buying stocks. And finally, visibility for AI has not even been affected by the government shutdown or anything. So companies are going to start, as they think about 2026, start making announcements. So I think in the final months, I think one surprise is the AI trade's going to come back strong because it's wobbled. But the Fed is getting people scared because is the Fed going to suddenly hammer down on things? But keep in mind, inflation has been softening. So if they cut in December, they're confirming they're on an easing cycle. Now that meeting's not for a few weeks. But that would be really bullish for financials and small caps. And by the way, what's correlated to tech and financials and small caps? It's crypto. So I think you're going to have a massive crypto rally as well.
How far do you think we get on Bitcoin by the end of the year?
Well, I think people have dampened their expectations for Bitcoin partly because Bitcoin's been treading water. And there have been a lot of OGs, original Bitcoiners that are selling above 100,000, but it is still an underallocated asset class. So I think Bitcoin actually potentially can get to the high 100,000s, maybe even 200,000 by the end of the year. I think it's a big ask, but to me, what's more obvious is Ethereum can have a huge move into year end because even Cathie Wood wrote about it. She thinks stable coins have been cannibalizing demand for Bitcoin, and gold and tokenized gold is cannibalizing demand for Bitcoin. But stable coins and tokenized gold run on smart contract blockchains like Ethereum, and Wall Street is building, and Larry Fink wants to tokenize everything on the blockchain. That means Ethereum is where people are starting to raise their growth expectations. And if you're raising your growth expectations, then your discount to the future is going up. So I think that there's a bigger move in Ethereum, and Mark Newton, our head of technical strategy, thinks we can be like 9,000 to 12,000 by January. I think that's about right. I think Ethereum, just 3,600 more than doubles between now and year end, or between now and January. One thing you're pointing out, and that's correct, is that 2025 is the third year where the S&P will be up double digits, probably up 20% this year. So 3 years of 20% gains in a row. Okay, remember at the end of 2022, people were saying we were Armageddon. Nobody was bullish. So in the last 3 years, wealthy individuals and hedge funds recommended people go to cash, or they do alternatives like private equity, private credit, or venture. But the S&P 500 has trounced all of those categories of assets. So this is a comeuppance because, 3-year return, what is someone's excuse for basically maybe having flat performance or up 15% when the S&P is almost, up 200%? So this is really the reason 2026 is probably not as bearish as people think, because now next year, I think people are going to be like, wow, wait, NVIDIA and all these are public companies and their earnings are growing 50%. I think people are going to actually start chasing them next year. That's really positive for crypto because, as you know, there is also this argument today that the crypto cycle is a 4-year cycle, so it should be ending now. So
Yep.
people are trying to fade that. I think people are trying to fade everything, the S&P and the crypto, but forgetting that the Fed is beginning to cut, and the ISM, and we've written about this, is more correlated to Bitcoin than monetary policy. And until the ISM gets to 60, Bitcoin really can't peak. So I think this is pretty positive for crypto. But crypto, it's kind of been hurt because, monetary liquidity hasn't been really increasing. The Fed has been under QT, quantitative tightening.
Yep.
That's ending in December. And the Fed hasn't really given clear signals that they want to ease. So I think there's been a little bit of confusion for investors.
Looking back, we're up about 80-something% of the past 3 years. What did the bears get wrong for the past 2 years as of 2023, 24? You've been one of the only voices saying, hey, this is going to happen. What did 90% of analysts miss about the past 3 years?
Scott Bessent famously has said in the past that, 80% of a trade is macro, and so I think for the last 3 years, most investors took that to heart and became armchair macro people. But what threw people off over the last 3 years was a few things. Number one, they were too grounded in believing there's a science to the yield curve. The yield curve was inverted. Now, we explained at Fundstrat that the inversion was due to inflation expectations. Inflation was higher near term, so the nominal rate should be higher near term, but it would drop long term. That's why the yield curve's inverted. But everyone said it was a recession signal. Number two, I think what people got wrong is that we never had experienced inflation before. So everybody was anchored in 1970s as the template, not realizing that we didn't have the same intractable conditions to cause inflation. So I think people were structurally bearish because they're like, curve's inverted, there's a recession. Second, we have stagflation. And then they missed that companies were real-time dynamically changing their business models to deal with inflation and a tight Fed. And they delivered good earnings. So I think Fundstrat, and our focus for our clients was, look, let's just find the best companies. They're not really going to be beaten up because of inflation, and that thesis proved correct.
I mean, you know what they say, time is the best friend of a great business, in the stock market at least, and the worst enemy of a crappy one. And that's true in inflation or in a bull market, doesn't matter. But I've heard you speak for the past few weeks, and it seems to me that we're repeating some of the similarities that what happened in 2022 when everybody's starting to get bearish right now about this market. They're starting to get anxious. And you are taking a position again that you think that we are still in the bullish setup. And I know your work. I've been following your work. So I know you've been bearish before. People just haven't seen it for the past 5 years. So you can be bearish. That's the one thing I've been doing this for 30 odd years. What do you think people misunderstand the most about the current setup?
Well, I think what people have a hard time understanding and grasping are super cycles, because Fundstrat's work by nature is thematic. We look for story arcs that last 10 to 15 years. So the reason we turned structurally bullish in 2009, was because our cycle work showed that there was a long-term bull market starting. And beginning in 2018, we identified two future super cycles. One was millennials and the fact that they're entering the prime age workforce. That was a powerful tailwind that would last up to 20 years. And the second was there was a global prime age workforce labor shortage. I know it sounds like plain vanilla to say that, but that was going to set the stage for an AI boom. So we're in the midst of an AI boom that is causing prices to levitate. but this is pretty textbook. In 1991 to 99, there was a labor shortage and tech boomed. 1948 to 67, there was a labor shortage and tech boomed. So tech is booming, and a lot of people look at stocks that have a high Sharpe ratio, right? They're just going up, and they assume it's a bubble. And so people have been chronically trying to short NVIDIA every step of the way up. And then the second thing people anchor to is that, well, many people aren't really that old in our business. I was actually an equity research analyst during the dot-com boom. So many people are saying this is just like the dot-com mania. There's some similarities, but we're so far from it. But everyone thinks that this is big again.